Gold. Is it time to buy gold yet? Well, let's find out. So, the analysis would suggest that that opportunity may be arising at long last. After this massive sell off here, which incidentally happened to be in line with the seasonality. The seasonality data for golds, silver, and all the other metals is actually quite bearish. They actually go down a significant amount during that period. If I can just load up my macro sheet here, we can see how that looks. Typically, now this sheet is not mine, this sheet is from, well, this picture I should say, the sheet is mine. This chart here is from marketsmadeclear.com. Gold, silver, platinum, palladium, they all experience very bearish circumstances during this month of March. And it just so happens that the coronavirus fears and panic actually inspired that sell-off to happen anyway. Some people are wondering, okay, isn't it normal that if stocks are selling off, if other things are devaluing, that we would have a safe haven bid on gold, on silver? Well, not necessarily in the current macroeconomic environment. In this environment, what we're actually seeing is a coupling of gold and the stock market. And there's a reason for that. That is because of risk parity. Now, risk parity refers to the way, well, a sort of portfolio construction technique in which they seek to create a higher Sharpe ratio by evening out the risk across the portfolio, across multiple asset types. Hedging, if you may. And because we are seeing this massive bear market, we're getting multi-asset correlation, which means that as the stock markets have gone down, let me see if I can head over to the fixed income markets here, we will find that the bond markets have gone down, which is usually the other side of this risk parity portfolios. What that means is, during this market crash, a lot of very large players in the markets have been forced to liquidate, to raise capital, raise liquidity for margin calls. And there's a reason why I'm explaining all of this, all right? So let's take a look at the US. Okay, we have these charts here, the 2-year, the 5-year, and the 10-year. And we can see what's really going on the charts here. It's amazingly bearish, and we can see that massive selling off happening here. Minor bounce. It's continuing to maintain that bearishness, and that is not something that is normal when it comes to correlation with stocks. What that means is that typical technical analysis type structures may not necessarily be the greatest strategy in this environment. Gold and silver will not cash the safe haven bid the way it typically would. What would happen is that we will need to see a decoupling of the stock markets and gold. Right now, as the stocks fall and managers need to raise funds to meet margin calls, they sell gold. So stocks have gone down, golds go down because they close their open positions. They need to raise capital from successful open trades, which is why we are seeing that sell-off on gold. So when do we buy into gold? Let's take a look at. Now, this is a correlation between USD Chef. Of course, we know they have that inverse correlation, as we can see going on here with gold. And at the bottom here, this is just the gold to silver ratio. The gold to silver ratio being this high reflects a massive amount of value for gold, especially in relation to silver. What that means is silver is actually very affordable to those who own gold. But we can see it's beginning to ease off here. We can see that also reflected in the inverse correlation with USD Chef. But let's go over to goldprice.com because I have something interesting to show you. Now, we can see that massive sell-off happening on gold. This is a weekly chart. It's just been bearish here. We got from 1700 down to as low as 1300, I believe. Yes, right? And that may seem like an indicator that gold is losing its value, but price is not always equivalent to value. And let's explore that now. Let's go to goldprice.com and let's take a look at the gold to Dow Jones comparison. Here we can see that as the Dow Jones Industrial Average is going down, Gold, although it has gone down as well, has maintained a fair relative value, which suggests that gold is actually still very much a valuable asset despite a depreciation in price, which means that moving forward, gold is still an attractive asset to buy. Now, this is how I construct my assets. That was funny. My my asset biases is that I look at the fundamental data and I determine a direction. And this direction that I'm determining here is a bullish one. I'm waiting for that stock to metals correlation to break down, or at least I should say coupling to break down, so that I can see the stock markets either easing off their massive sell-off, or that the metals are beginning to appreciate in value despite that sell-off. And at that point, that's when we know, hey, the money managers, the traders, the large institutional players, they've already met their margin calls. That phase is over. And we have new investors and new trades happening in the metals. So we're looking at a shift from everyone compensating for the massive losses in the stock markets towards, okay, let's try to reinvest and survive the next set of moves that are going to take place. All right, so gold is actually still relatively very valuable. Let's take a look at the gold to S&P ratio. We should get something very similar. There we go. It's actually appreciating as the S&P is depreciating. And let's take a look at the gold to actually US dollar would be interesting. Actually, I should show you that one. Let's take a look as soon as it loads up. The gold to US dollar ratio, as we can see. Now, gold is quoted in US dollars on the spot markets. So as the US dollar appreciates in value, relatively, gold would depreciate because $1 is now more valuable. So that's also something to be looking at. And if we go to the currency charts here, let's go to my dashboard. To anyone wondering, I use something called Koyfin charts. It's amazing. I came across it from the Market Huddle podcast and I fell in love with this chart system. Okay, so the dollar index, actually, if we zoom in, has finally caught that bid. So initially, I was really confused. The US dollar was selling off. Of course, we know that had to do with the stock market selling off and currency repatriation through other investors from other parts of the world. So as European investors sold off their American stocks, that currency conversion would have applied pressure to the US dollar relative to other currencies. But after that began to ease off, the US dollar is still the world's reserve currency, and we can see that strength would have taken place here, giving us that massive V-shaped recovery. Now this is also something that would have applied a lot of pressure to gold. So gold was under a lot of pressure. So another indicator that I would be looking at before going bullish on gold would be a bit of weakness, or at least consolidation, on the US dollar index. The US dollar index is actually on some very high levels here. These are the highs from 2016 here. It's not been this high in a very long time, and we're also looking at a lot of volatility. Okay, now when it comes to volatility is something that we need to look at to understand the psychology of longer term investors. If we were to take a look at the gold volatility index, we will see that it has actually been way too high for a lot of money managers, and I'll show you how that works. The gold volatility index has shot up recently, as we can see here. Sorry, I'm zooming in too much. We can see it here. What this does, those large money managers, they have rules which they need to abide by. When volatility gets too high, their job is to scale out of their positions, which would have applied further selling pressure onto the metals market. And we can go long on this market as soon as the volatility begins to come back down to more familiar levels. That's when it will also look more attractive to investors. Now, on the commitment traders data, if we come down here, we can see when it comes to gold and silver, a lot of long positions, this side here is longs, have been closed off, and the amount of investors, the amount of traders has been reduced. Okay, we had 201 traders in the markets go down to 180. We had 97 traders in the silver markets go down to 88 traders in the silver markets, as well as 18,000 contracts be pulled out from the gold market and 13,000 contracts being pulled out from the silver markets. And we can also see where they closed off some short positions as well. So we know that they're not interested in shorting these markets. We know that they're interested in simply closing off, liquidating those positions, and we need to wait now and see what the new positioning would be. So this is really a sort of repositioning phase, something that we need to look out for. In my system, the Confluence trading system, what I do is I try to play along with the big money so that I don't get run over by the big money. So if the big money is going long, I go long. If the big money is going short, I go short. So when the big money is being ambiguous, I wait. So signals for long on the metals markets. We're looking at weakness, control in the gold volatility index. We're looking for an easing in the US dollar strength from the US dollar index. And we are looking for that momentum to start to build in the opposite direction as metals begin to decouple from the selling off of stocks. All right, catch you guys next time.